The stock market's been on a tear as we near the end of 2024. Will the rally continue into 2025? Hello and welcome to the Cedar River Capital Market Touchstones slideshow update for the fourth quarter to date of 2024. The date today is December 16th, 2024, and today we'll be discussing what we believe to be the main factors driving the stock and bond markets today and going forward. My name is Paul Latta, and I'll be doing the speaking today, but my business partner, Baj Kochar, and I are both available for questions and discussion. Our contact information is on our website at cedarrivercapital.com. Our agenda today will start with a discussion about the recent market action, then we'll look at the macroeconomy to put some backing behind the market discussion, and then we'll move into a microeconomic view and look at key industry-specific drivers. Then we'll conclude with some longer-term observations about the investment landscape. The S&P 500 has done really well in 2024, up 28.5% as shown on the chart on the left. 2024 has been a very strong year. Over the last 5 years, the S&P 500 is up a solid 106.7% as shown on the chart on the right. 4 of the last 5 years have been good years for the stock market, with 2022 being the only down year. The bond market is up a more modest 2% year-to-date as shown on the chart on the left. Bonds are finally getting some relief from rate cutting on the part of the Federal Reserve, which started its first rate cuts in September of this year. But over the last 5 years, bonds are still down 1.1% as shown on the chart on the right. The bond market is still below its 2020 highs when central banks around the world cut rates to zero amid the early part of the COVID pandemic. Speaking of the Fed, this chart shows Fed funds rates over the last 10 years. As you can see, Fed fund rates are finally pulling off the rather elevated 5% plus level as inflation figures finally appear to be normalizing. The Fed cut rates by a half a percentage point in September, another quarter point in November, and appears to be on course for another quarter point cut in December, perhaps later this week. More rate cuts seem likely as we transition into 2025. This chart is from the Federal Reserve Bank of Atlanta and shows the consensus for Fed funds rates in 2025 to be cut another 1% or so from the present rate. The chart also shows the range of uncertainty about the rate projections. Assuming inflation continues to moderate as we have seen in 2024, the consensus projection as shown in the green line seems most likely. But Fed action will depend on the data, especially on inflation. Note the consensus is not showing a reversion back to the pre-COVID Fed rates of 0 to 2%, but rather seems headed to a terminal rate closer to the 3% level. Most central banks in Europe and North America are now in rate-cutting mode as shown here. The rate cutting mostly reflects weakening global inflation and not economic weakness, a few exceptions here and there. China in particular might be an exception since China is indeed facing economic weakness and cutting rates to spur the economy. India is also an outlier. India seems to be wrestling with an uptick in inflation mainly from food-related goods, so India has paused its rate cutting. Brazil is one of the few countries that is raising rates. The higher rates are aimed at defending the currency, which has been soft. We have 2 charts on this slide. The bottom chart plots the yield of the 2-year Treasury in blue and the yield on the 10-year Treasury in green. The plots look all the way back to the 1980s. The top chart plots the difference between these 2 yields, also going back to the 1980s. As you can see on both charts, it's normal for the yield on the 10-year Treasury to be higher than the yield on the 2-year Treasury, but the spread has on occasion gone negative, a condition known as a yield curve inversion. We've had a total of 5 yield curve inversions over the last 35 years, as you can see on the top chart. Economists watch closely for yield curve inversions since every yield curve inversion over the past 35 years has seen a recession occur in the 1 to 2 years thereafter. We've been in a deep yield curve inversion since mid-2022, the deepest inversion in over 40 years. But since the Fed began cutting rates in September, the yield curve inversion has all but disappeared. As shown here, the spread is now a positive 2 basis points, 0.02 percentage points. Does that mean the recession risk has disappeared? Unfortunately, no. As you can see on the chart, recessions did not occur when the yield curve was inverted. Rather, the recessions occurred within a handful of months after the yield curve stopped being inverted, and that's where we are today. Now, we need to tread a little cautiously here since correlation and causation are not the same thing. That is, prior recessions and yield curve inversions were driven by bursting bubbles. We do not have that same situation this time around since the recent inflation and Fed policy has been an outcome of post-pandemic recovery, not necessarily bursting dot-com bubbles and not bursting subprime real estate bubbles. Now, some investors might dispute this idea given the size of the move in the big tech stocks on the advances in artificial intelligence. That is, we might be in an AI bubble, not unlike the dot-com bubble or the subprime real estate bubble. Indeed, the overall market valuation is near a 20-year high. However, the dot-com bubble of 1999 and the subprime real estate bubble of 2008 were not only much larger, but neither bubble was accompanied by actual inflation of any substance. In other words, the inversion that started in 2022, months before the announcement of ChatGPT, I might mention, well, that was almost entirely driven by aggressive Fed policy, much more akin to the yield curve inversion of the early 1980s, a situation we have not seen in over 40 years. Let's return to the stock market and the key factors driving investment there, as shown here. We've already discussed interest rates, of course, so let's look at some of these other factors. Let's begin with valuation. The strong stock market in 2024, and especially the lift near the tail end of the year, has pushed the stock market valuation up to fairly elevated levels. This chart is using Robert Shiller's cyclically adjusted PE ratio, also known as the CAPE ratio. The CAPE ratio measures the valuation of the stock market relative to a smoothed version of earnings that smoothed out over the prior 10 years to eliminate the ups and downs of the business cycle. As you can see, the valuation is nearing its highs here at 38.9 times. That is a high level, though that is still below the level seen in the late 1990s dot-com era when the CAPE ratio peaked at just over 43 times. We should note here that valuation is not a strong predictor of imminent future returns. We'll talk a little bit more of this on subsequent slides. That said, with two back-to-back strong 20% plus years in the stock market, it would be unusual to have a third 20% plus year, a three-peat, if you will. That does suggest 2025 will be a stock picker's market, where those names with strong and repeatable earnings and not outlandish valuations ought to do reasonably well. Also, the elevated stock market valuations does increase the relative attractiveness of bonds. This chart compares the earnings yield on the S&P 500 to the yield on the benchmark 10-year Treasury bond. Whichever line is higher is the better value with this approach. It seems our elevated rate environment over the past several years and present elevated stock market valuation have now converged for the first time in nearly 20 years. The red line and the blue line are virtually at the same level. This most certainly increases the relative attractiveness of bonds. And with more rate cuts from several central banks likely in the offing, the bond market seems especially timely now. In our prior slideshows, we discussed the elevated level of money on the sidelines with retail money market funds well over $6 trillion. That's a large figure that could easily be redeployed into the stock market. However, with the stock market up over 100% in the past 5 years, total stock market assets have moved from just over $20 trillion to nearly $40 trillion, meaning the money on the sidelines at $6 trillion is less and less meaningful. So rather than track retail money markets, this chart simply shows U.S. household holdings of stocks, bonds, and cash. As you can see here, cash levels at 15% are actually a tad below the long-term average of 17%. Equities, in contrast, are well above the historic average. Bonds, by comparison, well, they're fairly close to their long-term average. Of course, stocks have done very well over the decades, much better than cash or bonds. But a normal portfolio needs to have a mix of cash, stocks, and bonds. Asset allocation is important. 2024 has been another year with a very narrow market. That is, just a handful of large stocks are responsible for the bulk of the move in U.S. markets. The big movers include 7 names: Amazon, Apple, Google, Meta, Microsoft, Nvidia, and Tesla. These 7 names are collectively known as the Magnificent Seven. The chart here takes the performance of the normal S&P 500, which weights each constituent company based on its market value, and it compares it to a version of the S&P that weights each of the S&P 500 companies equally regardless of size. As you can see, the size-weighted S&P 500 in blue has performed fairly close to the equal-weighted S&P 500 in orange in every year prior to 2022. Since then, the performance of the stock market has been dictated by the performance of the Magnificent Seven. The remaining S&P 493 companies have comparatively little effect. In 2023 and the first half of 2024, the driver behind the Magnificent Seven was generative artificial intelligence, and especially the gain in Nvidia stock. In the back half of 2024, the big gainer was Tesla. With the dominance of the Magnificent Seven in the last couple of years, the overweighted names have become more overweighted, and the underweighted names have become more underweighted. Will this change in 2025? Well, unlikely, though it is possible we could have a situation like 2022 when the S&P 500 was driven lower by the Magnificent Seven rather than higher by the Magnificent Seven. The Magnificent Seven stocks generally led the market all year in 2024, similar to what we saw in 2023. However, the first half of the year was driven by the artificial intelligence theme, which pushed Nvidia to its all-time highs. The second half of the year, in contrast, was driven mainly by Tesla. When you look at the table here of year-to-date sector performance, we can see here that the three best sectors, communications, technology, and consumer discretionary, well, those are the three sectors that are most dominated by the Magnificent Seven stocks. The style factor breakdown year-to-date also reflects the impact of the Magnificent Seven stocks. That is, Magnificent Seven stocks were strong in the first half of the year, a bit weak in the third quarter, and strong in the fourth quarter. The Magnificent Seven names were most overweighted in the growth style factor as shown in the light green, the best performing style factor in 2024 as shown at the top right. Interesting too that 6 of the 8 style factors actually underperformed the S&P 500. We were actually a little bit surprised that the quality narrowly underperformed the S&P despite a sizable weighting of Magnificent Seven stocks. We suspect this reflects a bit more subtlety. That is, Tesla in particular is the one Magnificent Seven stock that is underweighted in the quality style, mainly since return on equity at Tesla, well, that's well below those of the other 6 Magnificent Seven names, therefore not as a higher quality company as the other 6. Of course, since Tesla was the biggest Magnificent Seven gainer in the latter part of 2024, the quality style actually underperformed. The U.S. market outperformed most other developed markets in 2024, as shown in the table here. Most of that excess return was due to the Magnificent Seven stocks, as discussed in the prior slides. In contrast, the S&P 500 Equal Weighted Index, which does not assign higher weights to the Magnificent Seven, well, that shows a more representative gain of 16.8%, which is still above most other regions, but closer to the middle. Israel took the top position in the global league table here. That may seem surprising given the tensions in the Middle East. That said, the performance is consistent with the history of the Israel market, which seems to do well during conflict. China stocks have done well in 2024 to date, especially the H shares listed in Hong Kong. The main driver was the sizable stimulus measures announced in late September, both monetary and fiscal. The Hong Kong shares seem to rally more than the New York shares or the Shanghai shares, mainly reflecting the fact that most of the large Chinese internet and telecom companies are listed in Hong Kong. India's stock market was strong through the first 9 months of the year, but softened in the fourth quarter on weak economic reports and a lift in inflation, especially food inflation. Curious that in the prior quarter, India was strong on China reshoring, but China is now strong and India is weak. Latin America stocks have been under pressure recently, mainly related to currency softness and the related pressure to raise rates. Mexico in particular is seeing additional pressure, mainly on Trump tariff threats, immigration issues, and ongoing fears of judicial reform under the new president Claudia Sheinbaum. 2024 was an election year, of course, so this begs the question, how has the stock market performance in 2024 compared to stock market performance in other prior election years? As shown in the table here, the average stock market gain in an election year is 10.7%, a figure which incidentally is about the same as the average stock market gain in a non-election year. However, what is different about election years is that roughly half the gain in an election year happens in just the last 2 months of the year, in other words, after the election is over. Conventional explanation here is that the market always rallies after an election because an election removes the uncertainty about who the leadership is. The year 2024 appears to be following the same script. We have seen a sizable gain post-election. Is that big gain bigger than average or less than average? Well, both. It is bigger than average when measured on a percent gain since elections, about 9% so far versus 5% on average. And it is less than average when measured what portion of the 2024 gain occurred after the election, about a third of the total gain versus the historic average of about half the total gain. Prior to the election, there was much speculation about which sectors would do best under either a Trump or Harris presidency. With the election now a little over a month behind us, it would seem the Trump favorites would be outperforming and the Harris favorites to be underperforming. Yet, while there are quite a few headlines about Tesla and Bitcoin, the two biggest post-election movers, the actual broad-based sector moves have been fairly muted. Indeed, the main theme of big oil Trump versus big tech Harris, well, that's just not really played out at all. As you can see in the table, big oil actually modestly underperformed in the 30 days post-election, and big tech basically performed in line with the market. The bank sector did post a modest outperformance post-election. Recall, banks were regarded as Trump beneficiaries on possible deregulation. Healthcare stocks have modestly underperformed, though most of that underperformance was not an election reaction, but a reaction to Trump's appointment of Robert Kennedy to head the U.S. Health and Human Services. Seems Kennedy is regarded as a controversial appointment based on his views on things like measles, vaccines, and mushrooms. The big gainer among the large caps, of course, is Tesla, with Musk backing Trump pre-election. Trump's significant Chinese revenues and assets are less at risk from Chinese retaliation over possible Trump tariffs or other protectionism. Bitcoin was the other big gainer on prospects for lighter blockchain regulation. Small cap prison stocks also posted gains on possible immigration tightening, though these names are quite small, so unlike Tesla or Bitcoin, it does not take much inflows to spike these small stocks higher. Among the Harris stocks, again, big tech had little move. Most of the weakness of Harris stocks were smaller names, and in particular those tied to renewables like solar and wind. Cannabis stocks were also weak. One other notable post-election development was the two Trump ETFs versus the two Harris ETFs. For Trump, the MAGA ETF, well, that actually underperformed, though the Cruz ETF, that has actually outperformed. For Harris, both the Dems and the Nancy ETFs outperformed by just a hair. In essence, that means 3 of the 4 ETFs backfired post-election. Ouch. We'd now like to move on to part 2 of our slideshow, the economy. We'll begin with looking at GDP levels by country. Most regions of the world were showing positive growth in the third quarter, including all of the G7 countries. Of course, there were a few weak patches here and there. India in particular, we did see positive nominal GDP growth, but high food inflation dropped real GDP growth below zero. South Africa also posted a modest decline in GDP, mainly due to an ongoing drought and related softness in farm output. The softness in Northern and Western Europe appears to have bounced back, and most countries of size in Europe were in the black for the third quarter. However, we're not fully convinced that Europe is out of the woods here, since the third quarter data did reflect some level of tailwind from the Paris Olympics, a tailwind that does seem likely to dissipate in the fourth quarter. That said, the European Central Bank has been proactively dovish. Where is the economy headed? The slide gives a point and counterpoint view across 6 key points on the economy. Each point addresses the most bullish point followed by the most bearish second point. Our conclusion is that the strengths seem likely to modestly outweigh the weaknesses into 2025. Let's start with the Fed, and clearly the Fed is in rate cutting mode, and that's clearly bullish. But history shows that the Fed is cutting rates when there's a recession. Do we have a recession upon us? Our read here is the former assertion has more merit. The latter assertion misses the fact that the Fed is cutting rates as inflation falls like the early 1980s, not as the economy weakens like 2000 and 2008. What about jobs? The jobs picture is quite strong with excellent payrolls and low unemployment. But the temporary help index keeps faltering, and temporary help is actually a leading indicator unlike most jobs measures. Our read here is a little of both assertions. We do need to watch the temporary help index, which indeed keeps falling, but the decline is not yet to the point where it is impacting payrolls. How about innovation? Well, we've had new innovation, certainly with generative AI and the GLP-1 drugs like Ozempic, and they are driving earnings. But of course, those stories are old by Wall Street standards. So again, we agree with both assertions here, but our sense is that this is really about incrementalism while we await another narrative to move forward. On the bottom left, productivity, we do have a bit of a mixed bag here. Services are doing fairly well, but manufacturing is softening. We do not see that changing much for better or worse in 2025, but bear in mind that America is largely a service economy at this point. Housing prices do remain strong, but existing home sales are frozen due to high mortgage rates. 2025 will likely be more of the same. Yes, mortgage rates may drop somewhat as the Fed cuts rates, but we're still very unlikely to revisit the sub 3% mortgage rates anytime soon. On the consumer confidence remains strong, but we keep seeing softness in earnings at consumer-oriented companies, and from durables like cars to small ticket items like cosmetics. Yes, we have a mixed bag. We suspect lower inflation and lower interest rates will help redirect marginal dollars into these consumer-oriented companies going into 2025. So overall, a mixed bag, but again, we believe the strengths will likely modestly outweigh the weaknesses as we move into 2025. Inflation is moderating in most countries, as you can see here, but not at the same rate. Notably, 2 countries have reached the target 2.0% or below inflation rates, Canada and South Korea. Australia is very close at 2.1%. The trend of lower inflation has not been straight down. Notably, there have been several countries that have seen inflation relapses in recent months. India in particular has seen inflation nearly double from 3.6% in July to 6.2% in October on higher food prices. And closer to home, the US, Canada, and UK have all seen inflation creep higher from a collective average of 1.9% in September to 2.3% in October. There are, of course, a couple of outliers, China on economic weakness and Russia due to the war in Ukraine. There's been much discussion about new U.S. tariffs with the election of Donald Trump as the incoming president. This chart is from one of our custodians, Charles Schwab, and it shows the U.S. weighted average tariff rate going back to 1910 and going forward to include all the tariffs Trump is proposing to implement after his inauguration next month. U.S. history textbooks usually assert that Smoot-Hawley Tariff Act of 1930, well, that was one of the main causes of the Great Depression. So the proposed Trump tariffs are actually certain to be controversial since they dwarf the size of the Smoot-Hawley tariffs. Will all the tariffs be enacted and in full? Well, we're quite skeptical that all Trump tariffs will be implemented. Supply chain complexity is a fact of life today. Broad-based tariff plans without hundreds of line item exceptions just seem very unlikely. Will the tariffs improve our trade deficit? Well, tariffs in theory might improve our trade deficit, but of course, first of all, our trade deficit is fairly small, running at only 3% of gross domestic product these days, and not really as high a priority as our national debt at over 120% of gross domestic product. Will tariffs spike inflation? Well, yes, in theory, but not much if only a fraction get implemented. And of course, if a Great Depression arises, well, that's deflationary. Are tariffs just a negotiating tactic to force non-trade sanctions? Yes, absolutely. That is a role of the tariffs that are being proposed. Maybe not the sole role, but that is absolutely a role. Will tariffs shrink the budget deficit? Yes, but probably not by much if only a fraction get implemented. And if lots get implemented and we create a Great Depression, well, then the budget deficits may widen on lower tax receipts. Will tariffs create another Great Depression? Well, it will lower GDP in theory, but not by much if few get implemented. We'd now like to move on to part 3 of the slideshow, shifting from macroeconomics to microeconomics by looking at a handful of industry-specific factors that are shaping overall capital markets. We'd like to highlight 5 industry discussion topics here: the spirits industry, Chinese electric vehicles, continuous glucose monitors, natural gas in Europe, and the IPO market. The table here is showing the global database for the alcoholic beverages broken down into 3 categories: spirits, wine, and beer. The right-hand column shows the year-to-date performance of each of these stocks, and as you can see, the spirit stocks are severely underperforming, with the average spirit stock down 29%, and that's in a market that is up 28%, a huge relative underperformance. A big factor has been weak earnings. As you can see in the second column to the right, the average spirits stocks has seen its earnings estimates cut by just over 21%, much worse than the beer stocks or the wine stocks or the S&P 500 in general. Why are spirit stocks under such pressure? Will there be a recovery? The spirits companies are not exactly household names, and many are based outside the U.S., but the brands they own are absolutely high profile, and most are easily recognized. This slide shows the biggest brand for each of the 7 spirits companies on the table from the prior slide. Note that some of the companies have just a few brands and others are broadly diversified. Indeed, the slide here is organized from the most diversified on the left, Diageo, to the least diversified, Queicho, on the right. So for example, Johnnie Walker is Diageo's biggest brand, but only accounts for 5% of Diageo revenue. Jack Daniel's in the middle is just over 50% of Brown-Forman's revenue. Queicho's Baijiu is over 90% of Queicho's revenue. The main headwind to the spirits industry has been simple overshoot. In the early days of the COVID pandemic, inventories dropped with supply chain challenges. At the same time, consumers were engaging in pantry loading. As supply chains normalized and public gathering resumed, the pantries became overstocked. You can see inventory in the chart here, from understocked to overstocked in just a few years. Further, consumers have been squeezed by inflation and its food industry cousin, shrinkflation. This means that unit sales are slowing and consumers are trading down to cheaper brands. Further, there is evidence of a trend towards health and wellness, perhaps brought on by the new GLP-1 obesity and diabetes drugs. The spirits industry is seeing a few additional headwinds. Cognac continues to face trade uncertainty amid China tariffs. Indeed, China economic weakness has been a challenge for those countries that do business in China, like Remy Cointreau and Queicho. And there have been company-specific factors too, like unexpected CEO turnover at David Campari and softening of Pernod's anchor brand, Jameson Irish Whiskey. One of Warren Buffett's more famous quotes is, "Buy when others are fearful and sell when others are greedy." Does this apply to the spirits industry? After all, the sector is at the cheapest valuation relative to earnings in over a decade. The median multiple on 2025 earnings is now 19 times, which is well below the 10-year average of 30.7. Further, the median multiple is now below the market multiple of 22.3, a curious valuation quirk since spirits have always traded higher than the market multiple since spirits are staples, which in theory means they have no down cycles. So what are the spirits telling us here? As shown on the left, there's plenty of reasons to love the spirit stocks right now. Cheap valuation, easy comps, moderating inflation, defensive sector, ephemeral stocking issues. But on the right, there's also reasons to wait on the sidelines. More downward earnings revisions are likely. Additional consumer weakness is possible. We have possible new Trump-related tariffs, ongoing internal challenges. Our overall read here is that spirit stocks are nearing a bottom, but there's no big rush to enter. However, we are likely to become more constructive as we go through 2025. We'd now like to move on to our second industry topic, Chinese electric vehicles and BYD in particular. Will China's BYD Auto take over the EV world? Many in the U.S. actually have little awareness of BYD Auto since market share in the U.S. is pretty close to zero. But BYD is much bigger than Tesla on a global basis, and growth has been fast and steady. This slide shows a few representative vehicles in the BYD lineup. Most eyes are drawn to the picture on the right, the BYD Yangwang U9, which BYD is positioning to compete head-to-head with Ferrari. That's nice eye candy, but the eyes really ought to look to the left at the BYD Seagull, and in particular at that retail price tag of $9,700. Really? Elon Musk has been trying for years to make a $25,000 EV for the masses, and so far to no avail. The Seagull, of course, is an entry-level vehicle. However, the most popular BYD car is the one in the middle, the BYD Keen. Not quite the eye candy of the car on the right, but not the appearance of the econo car like the Seagull. And yet the price is a mere $13,700. BYD has a half a dozen other models not shown here, including a couple of SUVs. BYD global market share of EVs is about 21%. And that's about double that of Tesla. Now that measure includes both the plug-in electric vehicles, plug-in hybrid electric vehicles, as well as the battery electric vehicles. Within just the battery electric vehicles, the BEVs, Tesla is actually still marginally ahead of BYD at 19.9% market share versus BYD at 17.1%. Of course, within the plug-in hybrid electric vehicles, BYD is at 40.1% global market share. Number 2 is Li Auto at 9.5% market share. Tesla, of course, is at 0. Interesting, too, that China has 9 electric vehicle companies producing at scale, more than double any other country. Also notable that BYD is in the lead despite protectionism, especially from the US. Tesla, in contrast, actually sells worldwide. BYD valuation is near 10-year lows despite its persistent growth. This reflects a stock price that has seen very little movement in recent years despite an explosion in sales and earnings, up 5-fold and 10-fold respectively over the prior 5 years. On an enterprise to sales basis, BYD is now at 0.8 times versus the 10-year range of 0.6 to 3.5x as shown in the chart in purple. Of course, with the Chinese stock market under pressure in recent years, BYD is not the only Chinese auto company trading at multi-year low valuations. As shown here, the BYD valuation decline is, well, it's about on par with pure Chinese EV companies. It's a little bit worse than the declines in the Chinese ICE stocks, the internal combustion engine stocks, and it's a touch worse than the non-auto market leaders in China. In other words, BYD is not really standing out much from other Chinese stocks. As the largest EV company in China and rapidly growing, it would seem that BYD has the potential to become a story stock. Of course, that might be wishful thinking since most of the dozens of global auto companies do not trade like story stocks, but there are 2 auto companies that are at present story stocks, Tesla and Ferrari. Both names trade at about 11 times sales compared to the rest of the industry at about 1 time sales. Just a few years ago, of course, there were lots of story stock auto companies. Indeed, most electric vehicle companies, well, they launched as IPOs as story stocks. And there were a lot. Rivian, Polestar, Fisker, NIO, Nikola, Canoo, Candy, Faraday, Lucid, and many, many others. Most IPOs lose their story stock status after a hiccup or two, and then lockups expire and valuation then collapses. Indeed, Value Line used to have a policy that they would not pick up coverage on any stock that had not been public for at least 4 years in order to not get caught up in the collapse of the story. Once story stock status is lost, very few reestablish story stock status. It's not impossible. We're actually seeing it right now with some of the quantum computing companies, but it is not very common. Our read here is that BYD is unlikely to garner a story stock valuation. It's possible, but not likely. BYD stock is down with many Chinese equities, but the factors weighing on many Chinese equities will have less impact on BYD. China stocks have been weak, reflecting the struggling and over-leveraged property sector, trade tensions with the U.S. and others restricting exports, limited population growth, and geopolitical tensions around Taiwan. However, BYD is not especially vulnerable to additional trade tensions. Let's face it, Biden already placed huge tariffs on BYD, which is why there are no BYDs in the U.S. Additional tariffs from Trump will have effectively no effect when sales are already at zero. Also, there is the Musk effect. Recall Tesla makes and sells EVs in China, which accounts for almost a quarter of Tesla revenue. Elon Musk is proactively acting to prevent Trump from inadvertently throwing a wrench into Chinese auto manufacturing and sales. Our judgment here is that the Chinese EV automakers seem quite interesting in here, BYD in particular. Now, granted, there are risks out there at the top of the list, geopolitics risk around Taiwan. There's also economic risk for China in general with the economic slowdown that's been fighting for the last couple of years. Of course, the industry risks, it's a very competitive industry with excess capacity and company-specific issues with execution, product recall, and unions and whatnot. All that said, we do have a very inexpensive stock on almost all measures. It's rapidly growing in a business with economies of scale, has limited incremental trade and tariff risk as well as headline risk, therefore, and BYD, well, it is a blue chip company within the Chinese equities. So our view here is Chinese automakers seem interesting in here, the electric vehicles in particular, and BYD especially. We'd now like to move on to our third industry topic, continuous glucose monitors. Is Ozempic killing Dexcom? In other words, how are the GLP-1 obesity drugs impacting demand for continuous glucose meters, CGMs? Clearly, Dexcom stock is in trouble with the huge gap down in the stock price this summer. Dexcom, of course, makes continuous glucose monitors widely used by diabetics. Yet with the new advances in obesity and diabetes treatments with Ozempic and the GLP-1 peers like Mounjaro, should investors worry that no one will ever need a glucose meter again? Certainly with Dexcom slashing guidance this summer, that thought is in every investor's mind. Alas, though, the demand for glucose meters is healthy. Indeed, the new GLP-1 drugs appear to be driving demand higher for glucose meters, as GLP-1 usage drives demand for supportive measures to confirm efficacy. GLP-1s are a boon for glucose monitoring. This can be seen with solid gains from Dexcom peers, including Abbott Labs, Medtronic, and to a lesser extent, Senseonics. But this then means the collapse in Dexcom was really a self-inflicted wound. Indeed, it was. There were three main factors driving the guidance reduction: a major sales force reorganization, a bigger rebate eligibility situation, and share loss in the durable medical equipment channel. Can Dexcom bounce back? Dexcom seems likely to recover, but the recovery may take time. Valuation has certainly pulled back with the stock cut in half from its prior levels, but with the guidance reduction, valuation on enterprise to EBITDA runs at about 21.6 times. That's well below its prior level as shown in purple, which ranged from about 35 times to about 55 times over the last couple of years prior to the guidance reduction. Of course, the guidance reduction dropped growth estimates to near zero and well below the recent growth of 20 to 30%. Have the estimates come down enough to prevent any future gap down? We suspect so. The September quarter was modestly constructive. Notably, some problems are likely to resolve faster than others. The high rebate problem in particular is likely already in the rearview mirror. The Salesforce reorg will likely take another 6 months as broken sales relationships get redesigned and reassigned. However, the pricing issues in the durable medical equipment channel, well, those may persist a little longer. Our read here is that Dexcom stock seems interesting as a contrarian buy-the-dips play with a 2 to 3 year time frame. We'd now like to move on to our fourth industry topic, natural gas in Europe. Will Europe have another natural gas supply shock? Seems there is a Russia-Ukraine gas transit contract that expires in a few weeks and is unlikely to be renewed. Does Ukraine still transport Russian natural gas? Well, yes, it does. While most natural gas lines through Ukraine have been shut down or destroyed, the Brotherhood line is still operating at a diminished capacity, as shown in the table here, and that's the line that is likely to be shut down at the end of the year. Russia also supplies gas through the Blue Stream line, which runs through eastern Ukraine, but the Blue Stream line is located in the Russia-controlled Donetsk region of Ukraine and is not likely to be shut down. There are 3 European countries that still get natural gas directly from the Brotherhood line: Slovakia, Czech Republic, and Austria. Most of the rest of Europe does not receive natural gas from the Brotherhood line. Other European countries have already adjusted to the 2022 closures by a combination of increased pipeline imports from Scandinavia and Africa, increased LNG imports, and conservation and additional renewables. Some of the European-centric commodities have lifted here, likely reflecting the risks around the Brotherhood shutdown. Natural gas prices in particular are nearing two-year highs, but of course they're nowhere near the 2022 spikes that we saw right after Russia's invasion of Ukraine. Also, natural gas futures in Europe are sharply backwardated. Long-dated futures are running nearly 40% below the spot prices, which basically means that no one thinks these prices are going to stick. We're also seeing very limited push-through to some of the other Europe-centric commodities, the nitrogen fertilizers or European electricity prices or other commodities that spiked back in 2022. Our conclusion here is that the shutdown of the Brotherhood line, well, it's going to be more of a small aftershock compared to the 2022 situation, and there will be only limited long-term effects. We'd now like to move on to our fifth and final industry topic, the IPO market. The IPO market is showing some signs of life, as shown here on the left. IPO funding at $27.3 billion through the third quarter. Well, that annualizes up to $36.4 billion, which is nearing the pre-COVID level of $45 billion. Still a mile below the nearly $160 billion in 2021, but that was a level that most would regard as a bubble. Similar math on deal count, 121 deals year to date, annualized at 161, which is nearing, again, the pre-COVID level of about 170. Again, a mile below the 400 plus deals in 2021, but about in line with non-bubble pre-COVID levels. We tend to correlate the IPO market with the stock market, albeit with about a 6 to 12 month lag. And of course, we've had a booming stock market for the last couple of years. Also, the challenges of too many IPOs in 2020 and 2021 and the underperformance of hundreds of names, well, those memories are fading as the bursting bubble of 2022 becomes another year further back in time. The stock market, the IPO market, and the venture capital market are all related, of course. However, it seems the venture capital market, the VC market, is lagging both. Third quarter saw a modest pullback in deal flow. While Q4 figures have yet to arrive, we would be surprised to not see year-over-year growth. So 2024 ought to be ahead of 2023. Also, valuation seems to be lifting. For 2025, we have a cautious optimism for venture capital. While we do not expect the S&P 500 to have another 20% plus year, the stock market tailwind from 2024 ought to be healthy for VCs into 2025, and a dovishly oriented Fed ought to keep markets functioning. Before we conclude, we have two additional slides with top-down and longer-term views. The stock market is trading at a relatively elevated valuation, as we discussed back on slide 10, which ought to raise the question of whether we should be selling now. This chart adds a little color to that question, and it shows that valuation is in fact a fairly terrible market timing tool if you're looking out over the next year. Yes, the correlation between valuation and performance is modestly negative, but not deeply negative as one might expect. Further, the range of outcomes is extremely wide. Valuation is part of the analysis, of course, but valuation alone, well, that's a poor market timing tool when looking out over the next year or so. Finally, just a reminder about the benefits of the long-term view of investing. Positive years are more common than negative years. 68% of the years going back to 1928 were positive years. And the returns take the rough form of a bell curve, as you can see here, with most annual returns not too far from the average return of about 10%. The long-term view allows investors to ride out short-term fluctuations, benefit from compounding returns, and limit the impact of emotional decision-making. That concludes our slideshow for today. Thank you so much for listening. Again, please reach out if you have any comments or questions. Our contact information can be found on our website at www.cedarrivercapital.com. We would love to hear from you.